there's a lot of things that people should be doing, such as investing in real estate. But what I want to tell you today is that there are other ways to invest in real estate. We're not talking about being a landlord where you got to fix toilets or get calls at 3 o'clock in the morning. We're talking about getting the checks rather than getting the calls. We know all real estate agents want to acquire clients consistently so that they can grow their business and income for that great lifestyle. This broadcast brings you the best and top people in the industry to support that quest. This is Dave Fanale, and I'm here to bring you the Real Estate Skill Builder broadcast, Real Estate Talk-TGIF, brought to you by Real Estate Skill Builder and Align, your premier real estate solution. Good morning, everybody. Again, my name is Dave Fanale. This is Real Estate Talk TGIF episode 366. It is 361 weeks in a row. We've come here. We've shared so much knowledge here, mostly real estate knowledge. We've done a lot of mindset work. We've done a lot of back office stuff, front office stuff. We've talked about prospecting, scripts, and dialogues. And today we got something a little bit different for you today. Look, real estate is the thing for me that, and I agree with this, and most of my friends do, and colleagues, that real estate makes the world go round, right? And one of the things that we see or don't see is a lot of people investing in things that, well, you know what, there's no such thing as a sure thing. But one thing we do know that there's a lot of things being built all the time, and there's new technology happening all over the place. And right now what we've got is land. They ain't making any more of it. So it is a commodity that doesn't grow. We can build stuff on it, but it doesn't grow. So there's a lot of things that people should be doing, such as investing in real estate. But what I want to tell you today is that there are other ways to invest in real estate. Today, we're joined by Fred Moskowitz. Fred's a former engineer who traded circuit boards for cash flow charts. As the author of the Little Green Book of Note Investing, Fred's going to talk about today how to be the bank and collect checks instead of writing them. He's here to demystify the world of note investing and show us how to turn some debt into opportunity. And the important thing is, look, we're not talking about being a landlord where you got to fix toilets or get calls at 3 o'clock in the morning. We're talking about getting the checks rather than getting the calls. Fred, welcome to the broadcast.
Thank you, Dave. It's great to be here. Thank you.
So, every broadcast, we start with two different questions. One has nothing to do with the broadcast. Well, it has everything to do with the broadcast. The question is, Fred, what does TGIF stand for?
TGIF? Oh,
what does that stand for?
Thank goodness it's Friday, right? That's
Fred,
the most common interpretation.
That is true, but not with Real Estate Talk TGIF. It's thank God it's Fanale. I mean, come on. I mean, everybody's gotta have a reason to believe, right? Reason to go. Anyway, thanks so much for being here. The other question that we start always with, the journey. The journey of my guest is the most important thing to start with, because there's a lot of people that will see you being successful in this niche industry, and people making money and people losing money and everything else, because we've all made it, lost it. We've all made mistakes. And that journey, no matter what it is, shows the grit and the grind that one of the things we continue to do is continue to work. So your journey to me is extremely important. So if you would, tell us about your journey, where you started and how you got to where we're sitting here on this broadcast today.
Yeah, thank you, Dave. I'll tell you, I started out my career in life working as a computer engineer in the tech industry. It wasn't in real estate. I was working in the tech industry, real exciting times during the dot-com boom days and the birth of the internet. And so I watched and participated in this wild roller coaster ride. The dot-com boom, which was immediately followed by the bursting of the dot-com bubble. And if you remember, around that time, we had the September 11th terrorist attacks.
Yep.
And it created all this turmoil in the world. And the tech industry exploded right around the same time. And so living through that, I realized that I was taking on this huge risk because I was relying on the paycheck from my job. It was my only
Right.
source of income.
Right.
And it was a huge risk I was taking. Even though I loved the work I was doing, I realized that no matter uh, how valuable of an employee I was or how talented of an engineer I was, if there was a downturn, I could lose my job through no fault of my own. And so I decided that I wanted to diversify my income. And as I was growing up, I saw many people around me in my life doing really well by owning real estate. And I said, I like that. Um, I like the idea of owning real estate and having it earn income for you, right? This is all the idea taught about in the book Rich Dad, Poor Dad, right? Buy
Mm-hmm.
and build assets and
Mm-hmm.
own them, and then those assets generate income and cash flow for you. And so that's what I started doing, building up a rental portfolio. And that was my initial venture into real estate. But through my education in real estate, I started learning a little bit about a niche area called note investing, where you could own the note, own the debt, and become the lender. And so when I learned about that, I said, oh, this looks like something you could really scale up and grow into something big. And so I started to pursue that over the years. And it's been a wonderful journey. But note investing, it's all about becoming the bank, buying the loan, and now you become a secured lien holder against a property that you don't own. Someone else owns it. And we can get more into that later. But that's in a
So,
nutshell what note investing is.
so you're basically what it is that you're buying the note, which is part of which is the mortgage. No, there's the mortgage and a note when you buy a house, right? Explain the
Correct.
difference. Is there a difference there or no?
Yeah, there is. It's they're two separate documents. So the note refers to the promissory note, which talks about the amount being borrowed, the repayment terms, the interest rate, and all of that. The mortgage is the security instrument. That's the document that when you sign, you're giving up a security interest to the lender to protect their interest in the property for the money they're lending you, and that gets recorded on title at the county courthouse for in the public record for all to see, and so that when the property, if the property is ever sold or refinanced, they're going to pull a title search, and that lien is going to come up, and it has to get dealt with at that time. And so this way, the lender is always in a protected position that they will get paid back if their collateral changes hands for some reason, or if the property is refinanced.
So so does the mortgage need a note and the note need a mortgage? Sounds
Not
like a stupid question,
necessarily,
I
no.
know.
They're two separate things, but they refer to each other.
Okay.
So you could have a promissory note without a mortgage, and basically that's unsecured debt. That's what a credit card might be, or a consumer loan at the bank with no
Right.
collateral.
Right.
Then you don't have a mortgage. But if most lenders want collateral, they'll require it, especially with a property purchase, and so there will be a mortgage that comes into play. But
Okay.
that's the purpose of those two different documents.
Okay. So let's get down to the nitty gritty of what it actually means to be a note investor, to buy a note.
Mhm.
So, okay. So being in real estate for years and years and years, I've signed many notes, I've signed many mortgages. And I know that, the mortgages I do have, the notes I do have out there, they have a certain amount of value, right? So the
Yes.
note itself could be, let's just say the note is $100,000 just to make for simple math.
Mhm.
when you're looking for an investment, there's performing, there's non-performing, there's, I believe, reperforming. What are people looking for when it comes to this?
People could be looking for any or all of those. There's so many different types of notes. You're referring to different categorizations, and they're all available. It largely comes down to what is your risk tolerance as an investor for
Okay.
buying a loan, and you can tune that in to match your risk tolerance. It's like any investment, right? If you want less risk, lower risk, more safety, then you can find an investment tailored to that. And most likely it's going to have a lower rate of return on it. And if you're comfortable with taking on more risk, then you can earn a higher rate of return as well. And that all exists. There's no right or wrong aspect to it. It comes down to what's the right fit for you as an investor.
So when we talk the right rate of return, a rate of return, are we talking about the interest rate that was originally charged by the bank to lend that money out to that homeowner or whoever?
No, we're talking about the rate of return that you as the lender earn when you buy that note. And it can be different, usually more than the interest rate the borrower is paying. And why is that? Well, in the secondary market for buying and selling of loans, it's very customary that there'll be a discount given. So the loan, that $100,000 loan example you gave, that
Yes.
might get sold for 97,000 or 95,000 or maybe 90,000. And so if you're a good investor and you're good at negotiating a discount, that's going to drive up your rate of return. And it's going to be higher than the face value of the note that the borrower's paying on. Works
Okay.
very similar to the way the bond market works when bonds are traded.
Okay. So I want to buy that $100,000 note and I'm going to spend, let's say, $95,000 on that note. The rate of return is based on what I like to call yield, right?
Yeah.
So yield is basically your cash on cash rate of return. So however much money you make off of that $95,000 investment, because you're gonna pay the full 95,000, aren't you?
Yeah, whatever the purchase price is, that's what you'll pay.
Right.
Yes.
So whatever you get back. So if you make simple math, if you spend 95,000 for a note and you make 9,500 a year, that's a 10% rate of return, correct? That's
Yeah.
a 10% yield, correct?
Yes.
Okay. So how does one, okay, so this may sound like a crazy question, but can you finance that?
Sure. If you can find someone that's willing to lend on that, it's not easy.
Okay.
So typically, you're not using financing to buy a note.
Right.
You're using
Right.
cash.
You're
You're
using your
using
own funds,
cash.
right?
However, Dave, let's say you have a property sitting over here,
Yep.
free and clear, right? You own it outright. You
Right.
could go to your local bank and refinance that property and then take that money and then go buy a note with it that
Right.
pays you a higher return than the interest rate you're paying on the other loan. You could certainly do that, but it's separate. It's kind of a separate transaction. But absolutely, you could leverage another asset you have to do that. That would be the way to utilize financing to buy a note.
Yeah,
I
that's
wouldn't recommend it if you're starting out. Like that's definitely a bit more sophisticated thing to do. But yeah, it is possible.
so let's I want to get into that kind of stuff in a little while, but I want to really get into some of the, I mean, you've literally written the book on it, a little green book of note investing, right? And your book really serves as a blueprint for note investing. what is a pivotal lesson or strategy from the book that you believe in note investing might be overlooked in the process of people getting into this business?
Yeah. So for people getting involved to start out, I always say this, like the first question to think about is how much time do you have?
Okay.
And that will dictate the way you get involved in note investing. And here's why. You can either, there's two ways to get started. You can either go out to the secondary market and buy notes and assemble a portfolio, right? You
Mm-hmm.
can do that and build that up, and then you manage it. You're responsible for performing the due diligence, handling all the transactions, finding the notes, which involves it's highly relationship based.
Right.
So you have to build relationships with note sellers, and so that's how you build a portfolio. Now, let's say maybe you don't have time. Maybe you are um, busy in your profession. You're successful, whether you're a real estate agent or broker or a professional working in a different field or a business owner, and you don't have a lot of time. And you say, hey, I have money. I want to put it to work. I want to invest in notes. Well, you could invest in a note fund, which is professionally managed for you, where the fund managers raise capital and then they'll go out, they'll pool the capital together, they'll go out and buy notes in bulk quantity, they'll negotiate the discounts, they'll manage the portfolio, and then they'll pay back a rate of return to all the investors. And so this is a passive approach
Mm-hmm.
to note investing and be a passive investor. For some people, that's the right way for them. And it's an important question to think about when you get started is how much time do you have? Do you want to go full on into creating a business and working in it? Or do you want to be a passive investor and um, let professionals manage the note portfolio for you?
So that's
So,
like, that would be almost like, instead of investing in real estate, that would be like almost like investing in a real estate investment trust where you're buying you're buying just a piece of that investment, right?
yeah, or a syndication. It's a good analogy.
Yeah, it's a really good way for people to get. Is there a limit? I mean, I'm sorry, a lower limit, or will these funds take anything like $1,000 or $50,000? Is there a number that people have to think about when talking about this?
It's all across the board.
Okay,
I've seen from looking at different funds, most common is 50,000 as a minimum,
okay,
but there are other funds that they may have a minimum of 25,000 or they may have a minimum of 100,000. I recently looked at one that had a minimum of 250,000. And so it's all across the board, and it's a matter of finding the one that matches up for what you're doing.
okay. So when people start talking about note investors, what kind of questions or what misconceptions happen when you start talking to somebody? Are there basic mistakes or basic thought processes that are not consistent with what it is? What I mean by this question is the people coming to you asking questions when they think it's one thing when it's not what they're asking. So this one question can probably relieve some questions that you might get, or I'll get, or people watching this broadcast now or later
Yeah.
about the misconceptions that can happen here.
Yeah, absolutely. If you are buying notes and managing a portfolio, it's definitely not passive investing. That's a misconception. People think, oh, I'm going to buy these notes and then I'll just sit back and collect payments every month. And there's some work involved. There's a lot of work involved. And so um, I always, I always tell people if you want to do it, great. It's a great business. I love it, but it's not for everyone, or not everyone has the right amount of time it takes to devote to it. And so that's something to really think about. For a lot of people starting out, I encourage look at a note fund and see if that's a better way to get
Yeah.
started,
Yeah.
so that you are working alongside with professionals to provide guidance and direction, and they do most of the heavy lifting for you. So that can be a great option when you're getting started. Um, Another misconception is that you have to buy notes that are local to where you live. And I'll tell you what, uh, we buy notes all over the USA,
Mm-hmm.
nationwide. You don't
Mm-hmm.
need to live near the property. You don't go and visit it or look at it or any of that.
Right.
Everything you do, you're looking at data, you're looking at reports, you're looking at title. Um, and if there was ever a need to have an inspection done at the property, you just pick up the phone. You call a vendor that handles property inspections. They'll send someone out local to go out, take photos of the
Mm-hmm.
property from the exterior,
Right.
anything like that that you need for a very low cost. And
Right.
so you don't need to live near the property at all. And you're actually not allowed to like go and knock on the door as a lender. That's not appropriate to do that. So this is the misconception. So with note investing, you can invest from anywhere. You can invest nationwide, and that's something that offers a lot of flexibility and diversification. Like you have geographic diversification because you're spread out over all these different local real estate markets.
Right. So, so we talked about real estate and the difference between investing in real estate and investing in notes and REITs and stuff, and going to a fund. How do the market conditions that we're experiencing today in 2025? This is being broadcast on May 30th, 2025. How do the market conditions of, in most parts of the country, there's low inventory. In most parts of the country, there are still, except for Florida, multiple offers, 100, 150,000, even more over asking price. How does that market, the actual real estate market, affect or even coincide with note investing?
Yeah, there's some relationships. However, it's somewhat removed. And here's what I'll say about that. So the value of real estate impacts the value of notes, and the reason is because of the equity coverage. So a note that
Okay.
has a lot of equity coverage is deemed more desirable, less risk. Uh, if it's a note, let's say the property's worth 300,000 and the note balance is 150,000, there's so much equity above and beyond the loan amount, the loan
Right.
balance. So
Right.
that certainly changes the value. And if the pricing were to decrease, then that will impact as well. Um, so that's the biggest one,
Right.
that I
Okay.
see.
And that makes a lot of sense. So that brings me to this other question of most notes are sold, aren't they sold basically like after, right? Like within 6 months of them
Yes.
being issued? Like for instance, somebody buys a house today, they close on it, it's $400,000, right? And you get a note in the mail like 3-6 months later. Please be advised, we have sold your note to Joe Blow, and they're going to
Yep.
be servicing it through Joe Blow Servicing Company, etc. Are
Yes.
most notes sold then? The reason I asked this question, I'm pretty sure the answer is yes, but I want to go further in that we talked about the more equity that's involved, because most of these homes are going to be 20% down, let's say conventional loans. That's typically what happens. How do we get to the notes that have more equity in them? That's the reason for the question.
Yeah, the notes with more equity, they've been in place for a while. They're not 6 months old. They're 6 years old or more. The
Right.
loan balance has been getting paid down. the property maybe has experienced some appreciation as well along the way.
Right.
That's the
Right.
distinction. But loans, the example you gave, where within a few months after closing, the loan gets sold. Yeah, they'll get sold to Fannie Mae, Freddie Mac, or they'll get sold to a financial institution who securitizes the loans and sells them on Wall Street. And then a few years later, that Wall Street product gets broken down and all the loans get resold again. And so loans can change hands multiple times over. And the ones that are several years later, those are the ones where you're going to see a larger difference in the equity position.
Right.
And that's because you have had time on your side
right.
to do
Right.
that.
So haven't been into business a very, very long time. I've worked with a lot of buyers and sellers, and I always get this, Dave, what the hell? I just got this notice from the bank, right? Is it,
Yeah,
and we
people are
talked about this the other
surprised.
day. They're surprised and say, well, is the bank okay? Is that okay? We talked
Yeah.
about this phrase, the velocity of money, the other
Yeah.
day.
Yeah.
If this would be a really good thing to educate people on and why these things happen. So if you could explain it, that'd
Sure.
be great.
Yeah, and I talk about this in my book, in the Little Green Book of Note Investing. It's a very common question. People say, why do banks sell loans? Why do they do that? They went through all this trouble
Yep.
to underwrite the loan and qualify the borrower and prepare all the documents at closing. And it is a lot of work.
Yeah,
right?
They busted my chops for all the information. They wanted my shoe size. They wanted all this shit.
Yeah,
and now all of a
exactly.
sudden they're selling it. What the hell?
So here's what happens. Why do banks sell loans? Well, they'll sell the loan, they'll sell it at a slight discount. And why? So they can recapitalize. They'll get their money back. And then the very next day, they're going to turn around and create a new loan for someone else. And that's their business model. It's high velocity, high volume, and they make a little bit of money on each loan, the fees and the points and all that stuff. And maybe they collected interest for 3 or 6 months, which, by the way, if you've ever looked at an amortization schedule, the first couple of years of loan payments, it's almost all interest and very little principal. So they collect all that. And then turn around, and then the very next day, there's another person applying for a mortgage, waiting on a closing, and then they have the money to fund that next closing. That's how they stay in business. And so that's all about the velocity of money.
So when we talk about the amortization schedule, which is what you just referred to, where you see every bank, every time they give you do you do a mortgage in a note, you're going to get this thing attached called the amortization schedule. And it talks about just what you just said. You're going to see that, on a $200,000 loan, you're probably giving them $8 a month in principal and the rest in interest.
Yeah.
So as we talk about note investing, is the timing of that amortization schedule important for the investor?
It can be. It can certainly play a part in the analysis that's done when buying the loan. And let's just say if it's not to the liking of the investor, they may come back and want to negotiate a greater discount for that reason. And that's it, right? Any loan could be made more attractive, more palatable by offering a better discount. Right.
So when you buy the note, you're buying it within wherever it is in that amortization schedule, in that 30-year amortization schedule. You're buying it within that.
Yes.
So I'm just trying to make sure that I understand this and talk as the dumbest person in the room, which I typically am. I always love to ask these questions. Is okay. So it's in the 5th year. Or let's say it's in the 10th year, which typically doesn't happen. But
all right,
use that as an example.
10th year, and the loan is a 10-year loan.
Right. And most of
the loan balance is small.
So the interest is small. So the return on that investment would be small. No, the longer you go through the amortization schedule.
Yes. So
cool.
the holder of that loan has to make a decision. Do I want to continue holding this loan, or do I want to get it off my books and I'll be willing to discount it more than the typical market rate to get this sold? And they will, right? There's always note funds that maybe they're closing the fund. They have to get all the loans sold before the end of the year. And so they will be very aggressive with discounts. And that's okay. They've made their money on the portfolio already.
Right.
They're willing to take on a greater discount in order to get things closed up and wrapped up. And that's okay. It's a business decision. And so
Right.
if you are an investor and you're uniquely positioned to take advantage of opportunities like that, it could be really beneficial. Then you may say, hey, you know what? I'm not that excited about buying a loan that's in its last year of amortization, but for the right discount, maybe I can be a little more excited about it. And that's
Right.
okay. Yeah.
So let's talk about something that's really important to a lot of people, liquidity, right? So if we own a piece of real estate, right, the building itself or the property, we put it on the market. Depending on where you are, will depend on how long it's going to take to sell your house. Typically in northern New Jersey, where I'm located, we're looking at anywhere from so probably 5 to 55 days. And if it goes longer than that, there's something wrong with your price, by the way, guys, just putting that out there.
Yeah.
But what's the liquidity on a note? I mean, can you just go say, hey, I got a note for sale. I'll give it to you for $8?
Yeah, absolutely. If you have done a good job in building out your relationships and your network of other note investors, note funds that buy notes, you can make some phone calls. And I'll tell you, Dave, notes are very liquid. They really
Are
are.
they really?
If you know who to call and you're willing to offer a discount like you did when you bought it, you could get a note sold in a couple of days or a week. That's not unheard of,
Right.
especially if you know someone that buys notes like the one that you have. They'd be interested to hear about it. And they will probably appreciate getting a phone call from you first, that you offered it to them first. And
It's just like
so, yeah, it's important. One of the most important things about being a note investor is being good at building those relationships, because that's what
yeah.
makes everything work. It's no different than for you
No,
as a
it's
real
not.
estate professional, right?
Right. And that's exactly what I was just going to say when I started talking a second ago is you have to build the relationships with all different things. And it's just a little bit different. Look, no, you can spin it any way you want. It's still a relationship business, because what you have to know, it's like, okay, so in New Jersey we got this thing. I'm sure you have in other places. I got a guy. You need something done, I got a guy,
I know
right?
a guy. Yeah.
Right. I
Yeah.
know a guy. I got a guy. No worries, right? It's like I'm having some work done on my house over the next couple of weeks, and I got guys. I know who to call. I know how to get shit done, and that's who I call. I tell them what to do. They tell me how much. If I like it, I pay them. If not, I haggle and then go through. Then we don't talk about that word haggle anymore. But anyway, all right. So there's a lot of ways to buy these notes. We buy them from cash, and we can leverage other investments. We can leverage real estate. What about retirement accounts? I mean, is that something that's easy to do, to use retirement accounts like an IRA or a 401k or all that stuff? Can you use that to invest?
Yeah, absolutely. I'm glad you brought that up. That is an excellent source of capital for investing. And I cover 2 chapters in my book specifically to this: how to invest in notes using retirement accounts. And yes, you can use IRAs, 401k money, even HSAs. You can have HSAs and invest in
Really?
notes that way. Absolutely.
You're talking
Yeah.
about a health service account, right?
Yeah. Yep.
Okay. How do you
Yeah.
do that? I mean, there's money, you're putting money in that account for future issues, correct?
Yes.
Okay. All
Yes,
right.
you that's correct. But along the way, you can have investments in those accounts, right? You can invest in a mutual fund, or you could own an asset like a note in there. It doesn't have to sit in cash. You want that to grow over time, right? Hopefully you're healthy and you won't have a lot of medical expenses until later on in life. So all those years, you want that to grow and compound. And so that's a great way to do it. But absolutely, a lot of people, investors I speak with, they may have a 401k from a previous employer, or they have an IRA sitting there, and to say, hey, Fred, I have this cash. How can I buy notes? How can I invest that? And so, yeah, I definitely cover this in several chapters in my book, because it's an area that's often overlooked, and it's a great way to put that capital to work. Right, we all work so hard saving money, setting
Right.
aside in our
Right.
retirement accounts. Well, what about the idea of putting that money to work, so that each of those dollars that you have, they're acting like an employee of yours, working on your behalf, earning a return. That's what you want.
So you can also do that with stock accounts too. If you've had stock for a long time and it's doubled or whatever, and you've done very well, thank goodness it's done very, very well. You can actually borrow against that for the same thing, correct?
Yes.
Okay. So just really quickly, how is something like that done? How do you borrow against a stock account or a 401k? How do you actually do it? Are you paying interest to yourself when you borrow that money?
You're paying interest to whoever lent the money. Yeah. So if it's a
Okay.
stock account, you could go to a traditional bank or lender and say, hey, I want a loan. I'm giving this stock up as collateral, and they'll do that for you. That's a common type of transaction.
Just out of
So
curiosity,
it's going to be
what
whatever the terms are that they
right.
ask for, right?
Okay. Do
Because the
interest rates do high
lender
interest rates
drives
come into
that.
do interest rates come into play with that, as far as high interest rates of what we're dealing with? Are they lower interest rates? Do you know?
It's going to be whatever the
Whatever
lender
the
and the
bank wants
borrower
to charge.
agree to. Yeah.
Okay. All
That's
right.
really market driven.
So so as we move along in this note investing, there's, as we mentioned, this word was mentioned earlier, servicers or whatever. You have a servicer that's going to
Yeah.
service your note and is going to collect the money, going to send out all this stuff. How does that actually how does that role of loan servicing companies in note investing, and how do they contribute to your success? How do you do that? Because you're not collecting the money,
Right.
right? How
Yeah.
does
The
that
loan
work?
servicer's handling that for you. The servicing company, they will collect the payments. They'll send out the monthly statements to the borrower. They keep track of the amortization schedule. They answer phone calls from the borrower. They send out the end of year tax statements that have to be sent out. They do a lot of compliance work, and they do all of this for very low cost. They'll charge a monthly fee to the lender
Mhm.
for that.
Okay.
But think of it like the same way that a property manager can manage a rental property on
Yep.
behalf of the owner. The loan servicer, they'll manage the note on behalf of the servicer. And this is a lot of administrative burden that they take off of your shoulders as an investor. And this is why we're able to scale up a portfolio very quickly because of that. So it is
Okay.
one of the most important vendors that come into play as a note investor.
So, all right. So I invest in a note, and they get a notice that says your note and mortgage has been sold. Are they going to say your note and mortgage has been sold to David Fanale and being serviced by Joe Blow Servicing Company? Are they going to actually say who bought the note?
There are different compliance letters. It won't be in the same one, but
Okay.
that the servicing, there's one for servicing and there's one for ownership. They're separate. But
So there is
absolutely, when a loan is sold, the most important one is the servicing transfer
right.
to say, starting next month, please send your payments to the new address. Here it is. Here's their phone number, their contact information. And there will be a goodbye letter sent from the old servicer and a
Mhm.
hello letter sent from the new servicer. So the borrower will receive actually 2 letters about that.
So there's a certain amount of disclosure that is required and that does happen,
Yeah,
and actually
absolutely.
who does own that note.
Yeah, absolutely, because no one wants to be subjected to any kind of fraud or anything. And certainly, homeowners want to make sure that when they send money up for a payment, that they're sending it to the right place, that they're confident it's going to be credited against their loan balance, and
Mhm.
all that. They're not going to blindly be sending off payments to whoever asks for one.
Okay,
So there
cool.
needs
Right.
to be a clean handoff for that.
Right.
Absolutely.
Right. And that's all. And basically the system's already really set up, right?
Yeah.
Yeah,
Yeah,
system's
it's
already
very
set up.
common transaction. It is.
So this is getting into note investing is a little bit probably a little bit more involved in becoming a real estate agent, right? And one of the things that we always talk about as being a real estate agent is, okay, we want you to get your license, we want you to learn the business. There's really no barrier to, except for cash, there's really no barrier to entry to this business, correct?
Yeah.
Okay. You got to have the knowledge. You should be educating yourself on everything, starting with your book, of course. And the question I have is, when we have a lot of people getting into this and people that want to do more and more and more, is there an easy way, just like to scale your real estate business of sales and buyers? Is there a way to scale loan investing aside from the basics of having the assets to do it?
Yeah, absolutely. It's building relationships, working with competent professionals, getting involved in your industry, going to industry conferences and events. Those are all important. And it's not unlike any other business.
So do crazy things happen in this business? Do crazy things happen in note investing? Like there's all kinds of, I mean, every industry does have stories, has stories. What are there any? And can you share with us any of yours?
Yeah, absolutely. A lot of crazy things happen. I would say the one that's the most surprising one is is this. There's an element of randomness to note investing, and
Right,
the reason is you never know when a loan is going to get paid off. Borrowers have the right to pay off their mortgage
right, right,
anytime, right?
right,
And if you bought it at a discount, what the thing is, the borrower pays off the loan at the full loan balance. And
right.
so all of a sudden you have upside coming in that you weren't expecting. But there's cases where you could buy a note and then the next you have it, you get it all set up with servicing, you did all that work, and then the next month they pay it off. Why? Because the borrower, maybe they refinanced to get a lower rate, or they moved into a bigger house, or any life
Right.
things that come up. And you never know that that may happen. But remember that the average life of a loan in the United States, the statistic is 5 to 7 years. And it could
Just
be
gonna ask you that
one,
question.
and it could be 27. You never know.
Right, right. There are people that keep that loan and pay it all off, and
Yeah.
the old thing we used to talk about is, when are you going to burn your mortgage? We always talked about that years ago, right?
Yeah.
So as we get rolling here on this broadcast, a couple of questions that come to mind is, what have I missed? What questions have I not asked that I should be asking you when it comes to note investing? I feel like I've got a little bit of knowledge, and with your book, the Little Green Book of Note Investing, I could probably do a lot better, and I could probably be ready to go. What am I missing? What didn't I ask you?
Yeah. I would say you didn't ask me about the importance of working with professionals.
There you go.
With note investing, it's very easy to lose a lot of money very quickly if you don't know what you're doing, if you don't know what you're buying. You might buy a note only to, after the transaction, find out that it's not secured by any property, even though you thought it was, or maybe the
Hmm.
seller represented it to you that it was, but in actuality, it's not. And you want to have the education and knowledge to perform due diligence thoroughly to catch any problems like that before you buy the note. Because once you buy it, you own it now, and that's it. There's no going back. And so due diligence is super important to get good at it and have professionals on your side where if there's something you're not sure of or never encountered before, you could ask for help or
So
hire
who
help,
are those?
whatever it is, right? Very important.
Who are those professionals? What are they? What are they?
Yeah,
Are they
your
hedge
loan
funds?
servicer, your
Okay,
attorney,
right,
your vendors that provide title reports,
right,
um, all manner of vendors. If you're looking at loan documents and you're not comfortable with what you're looking at, calling your attorney and hire them for an hour to review the whole loan file and all the documents and pay them for an hour of their time. That's money well spent, especially if
right,
that was your first note that you were buying. They will look over everything and say, hey, here are some risks that we've identified.
right.
So, just know and be aware of it. Or they'll say, hey, there's a serious problem with this loan. You may not want to buy that. Or you may say, hey, I'll still buy the loan, but now I'm going to negotiate a deeper discount because of this issue we found. It's just
Well,
like when you're buying a property, right? It's the same kind of experience as well. You want to learn about
exactly,
all the issues before closing, not after.
exactly. And I just put up on the screen giftfromfred.com. That's goes to your site as well.
Yeah, yeah.
And
Thank you.
so,
I have
I want,
I have a guide, a note investing guide that I put together to and if you go to giftfromfred.com, you can put your information in to receive that. And I'm happy to send that out at no cost. Gets a little bit more involved in note investing and what it is and more information. And so happy to offer that resource to your audience and your community, Dave.
right. And I know you can also, I know also it's on your website to get the book as well. And we put giftfromfred.com. We also have your Instagram up there. Fred, I got a couple more things, and this has been really enlightening to me because I looked at note investing shit probably 30 years ago and I never did anything with it. It kind of scared me, to be honest with you. But because I didn't have the capital, right? But the question I have for you is really important for this broadcast. I ask it every week. How can I help you grow your business?
Thank you. Well, you're helping me already by having this platform, this community that allows me to share a little bit about my experience and knowledge and the business of note investing. And if anyone wants to learn more or get involved, please reach out to me. I love building relationships. I love hearing from investors, learning about what you're doing. And it's a wonderful thing. Building relationships, as I said it earlier, it's one of the most important things that we can do. And thank you.
Well, that's great, man. And one of the other things is with this broadcast, one of the things we do all the time. Before we get to the last thing, I want to say that next week we have Brandon Brittingham coming out. He's a CEO and the Maryland and Delaware group. Brandon Brittingham is the probably number one investor in the country. He's just an amazing human being. He didn't write a book, but he's just an amazing guy. And I am in awe of this gentleman who I met over a year ago. Just nice man, knows his shit. He's going to talk about investing. Here we're talking about note investing. We're going to talk about investing in real estate and everything else is going to be really cool. Anyway, Fred, I want to thank you so much for being on today. And of course, everyone that joins the broadcast gets the blue hat and it's going to be coming out to you. It's something we do. RE Skill Builder. It's the RE Skill Builder hat. We have hundreds of people all over the country that have these hats, different colors, different iterations, but nothing's changed with me. I'm still here every week. Fred, thank you so much for being on. Again, everybody, reach out to Fred at fredmoskowitz.com, giftfromfred.com, at the Fred Moskowitz on Instagram. We got great shows coming up next week, and we got our 7-year anniversary coming up too in June. So, and just wait for that. But we've got a lot of stuff going on. Fred, thanks so much. Stay on for a couple of minutes after we finish. And Nelson, thanks so much. Hit the videotape.